All right, everybody. Special shout out to David for asking me to do this video. Pretty much what we're going to do here is we're going to dive a little bit deeper into the consolidation pattern, which is also known as a channel pattern. Really, what I'm going to do today is I'm just going to break it down. This should be a relatively brief but very insightful video. I'm going to break down what exactly consolidation is, why it forms, and what the right way to trade it is. So I'm sure most of you are familiar with the actual pattern, and that pattern goes something like this, right? So the pattern, we have a stock, and it can come from the top or from the bottom. That's not necessarily what we're looking for. We're looking for a pattern that looks something similar to this, and of course it's not going to be perfect. Patterns in the real market are never perfect, but what we're looking for is we're looking for a pattern where it's putting in highs that are almost at the same exact level, and it's putting in lows that are almost at the same exact level. So what this is called it's called consolidation. Consolidation means basically consolidating. So a stock is, when it's not moving higher and it's not moving lower, it's consolidating or moving sideways. This is also called sideways motion, sideways trading, or channels. It's called channels because it kind of looks like a channel. So this is the general pattern that we're looking for. Of course, you're going to have patterns that also look something like this that are not exactly not exactly so uniform, right? But what we're looking for is we're looking for that relative area. Let's see if I can draw this. So we're looking for that relative area where you get similar highs and similar lows, okay? So both of these are consolidation. This is a perfect pattern. This is more like something that you're going to see in real life, right? When you're trading the actual market, it's not going to be exactly perfect. But either one of these is consolidation. Basically, why does it happen? Well, it happens for a couple of reasons. Remember, when it comes to the market, you have buyers and you have sellers. All right, and it's always a constant supply and demand battle, pretty much. So supply versus demand. When you have too much supply and not enough demand, the stock falls. When you have too much demand, not enough supply, the stock rises. That's pretty much the fundamental concept of supply and demand, and it is one of the major driving forces for the stock market and for price action moving in general. Okay, yes, of course, people will chalk it up to fundamental analysis, news releases, things of that nature, or technical analysis, certain patterns, things of that nature as well. But in reality, for a stock to move higher, you absolutely have to have more buyers than sellers, and you have to have more buyers willing to buy higher than the current market price. That's the other thing. If buyers are not willing to buy higher than the current market price, you will not have a movement higher. So when you have consolidation or channel trading, something like this, what you're seeing is you're seeing an area where sellers are taking over. So up here, sellers are taking over. There are more sellers than there are buyers. So the stock moves in this area, and then for some reason in this area, sellers take over. There becomes an oversupply issue. So let's say there's 5,000 buyers, there's 10,000 sellers. All right, down here it's the opposite. Say there's 3,000 sellers, but 8,000 buyers. All right, so you get this jolting back and forth movement. So what we're looking for is this is setting itself up for basically eventually somebody has to win. Either the buyers or the sellers have to win, right? If not, the stock is going to move like this forever. So let's say we're trading this, and let's grab this, let's extend this slightly. So let's say we continue to trade this, well, not trade this, but watch this. We're watching this, we're waiting for our place to enter. And something like this happens. Okay, so what do we have here? We have a level where buyers kept being overtaken by sellers. Buyer power, seller power. But for some reason now, we had an area where this broke, right? And buyers took over, right? So this is what we consider a breakout. This is a breakout. And when it comes to the pattern, the way you recognize this is because you see a breakout of the pattern. But if you want to really understand the in-depth of it, what's going on here is supply and demand were in battle. They were battling each other, right? And supply lost and demand won. So that means buyers took over. It could be because of a news release. It could be because of some sort of fundamental cause, and usually it is a fundamental cause. But what's beautiful about technical analysis is we see the fundamentals on the chart, and we can see the psychology of what's actually happening. So let's say companies released their income for the quarter, right? Let's say this company released its income for the quarter. Well, and the stock was moving up, and then boom, they released their income, their net income, and let's say they have net income per share of, let's say it exceeded expectations, right? It exceeded analyst expectations. Well, then that's going to cause buyers to jump into the market. They're going to say, oh, this stock is doing well, this company is doing well, and they're going to jump into it, and you're going to get this push higher, right? So a couple things can happen. Really, one, we want to enter here. We want to trade the break, okay? Now, what we want to see happen is we want to see that continuation, but that doesn't always happen. What may happen is we may get a retest, and this is called a retest of the level. So you get a break, you get a retest here, right? Because remember, support and resistance is the same thing as supply and demand. Resistance is, in essence, an oversupply. Support, in essence, is an over demand, all right? So in the markets, usually resistance, once it's broken, turns into support. So sometimes you get a retest and then a bounce. That's okay. We would enter here. We would ride this up. You can also get a retest into the consolidation pattern. This would be what we call a failed breakout, a false breakout, or a fake out. All right. Basically, it looked like the move was going to happen, but it did not happen. All right, and this is kind of what I teach here at Finance and Chocolate in the main course and pretty much everywhere. My mentality of, look, we're not always going to be right, and it's okay. You don't have to always be right. Why? Because we would want to stop ourselves out, right? We would take a small loss, and what would we do? Maybe the stock would go down more. Maybe the stock might bounce around a little bit, come down, maybe test again, maybe bounce to the bottom, and then maybe finally it breaks out again. Okay, so what we did is we took a small loss here, but that's okay. Then we re-enter here, looking for the same exact process. We would put stops in here, and we'd want to see either a retest of this level and a continuation, right? Or we'd want to see just a straight up continuation, right? Either one is a valid play as long as we keep our risk management the way it needs to be. And that's a big thing. And that's pretty much why I'm so adamant about systematic trading, about back testing, about all these things that are really extremely important. If you're going to trade professionally, you need to act like a professional. And just randomly trading is not acting like a professional. You have to make sure that your risk management is right, that your trading strategy is right, that your back testing is right, that your trading statistics is right. Everything that I talk about in the Trading Mastery course, the 10-hour Trading Mastery course, is designed to pretty much change your mentality, because too many people think that it's about being right all the time or that you have a magic ball. It's not. It's just a numbers game. Business in general, no matter if it's trading stocks, no matter if you're starting your own fucking lemonade stand, it doesn't matter. Business in general is a numbers game. And as long as our numbers tell us that our strategy is going to work out, then we continue to trade it. So we don't mind these small little losses here. We don't care about these small little losses, because as long as we get one winner, and if we get a winner that breaks, right? Because this is eventually, this needs to break to the upside or to the downside. This winner here is going to cover 5 or 6 of these small losses. All right, so that's what we're looking for. We're looking for a breakout. And basically, we're looking for a level where either buyers or sellers take over, because this is all great, but we can, of course, trade this to the downside as well. And the process would be the same thing. We would look for a breakout. The only difference is everything would be in reverse. We would take the trade here, we would put stops here, and we'd want to see either a straight continuation or a retest and then a continuation, or we may very well get stopped out. We would get stopped out right here at this level, right? And then we would just wait for the re-break to trade it again. No big deal. Though all we want to do when it comes to taking losses, we have to start to understand that, look, taking losses is a part of trading, and it's too many people think, or too many people make it seem like, oh, that's a bad thing if you're taking losses. No, it's not a bad thing if you're taking losses. It's a bad thing if you're taking uncontrolled losses, pretty much losses that you just let. So if something like this happened and then we don't stop ourselves out and we lose all this money, that's when it becomes a negative. But taking small losses and stopping ourselves out right here, no big deal. We want to take those small losses so when we finally get a huge winner, we make up for the losses and we make a profit. So hopefully this was informative to all of you guys, especially you, David. Like I said, shout out. I really like to do these videos. I like to help as much as possible. Really, I want you guys to see Finance and Chocolate not just as a trader teaching you, which it is. I am a trader and I am teaching you, but I also want you to see this as a community led by me. I want you guys to be able to feel comfortable interacting with me, asking me questions, things of that nature. For those of you that are in the Trading Mastery course, don't hesitate to ask me to schedule a Skype call. If you're not understanding something, request a Skype call or request a video to be done, and I will add that video to the Trading Mastery course. That's why that course keeps growing, because of you guys, because you guys request what you want in that course, and I add it because I want to improve the experience, and I want you guys to have an education that continues to grow with your ability. So as your ability grows, the course will grow to keep pushing you. You might think that you're getting really good, and then boom, another lesson will be added, and it'll push you even further. And then it'll push you again. That's really what I want you guys. I want you guys to see this as a community. I want you guys to see this as interactive. And when you have questions, please do not hesitate to ask. So hopefully this cleared the consolidation pattern for a lot of you. This is one of the most fundamental patterns in trading, because a lot of the advanced patterns, what we call advanced pattern trading, a lot of it is based off what? Based off support and resistance. Pretty much everything in the market is based off support and resistance. Why? Because everything is based off supply and demand. So when you have a consolidation range, a channel, all right, what you're looking for is you're looking for areas on either side of the channel where buyers are winning here, sellers are winning here, and it is a battle between supply and demand. Too much supply, too much demand. Too much supply, too much demand, too much supply, too much demand. But if we get a break, what that means is the level where demand was holding now is not holding. So the moment this breaks, basically supply wins. Sellers win because it finally breaks, which means sellers were able to have more sellers in the market, and they were willing to sell at a lower price than the market price. Does that make sense? That's what we're looking for. And of course, buyers were willing to buy at a lower price than the market price, because for every seller, you do need a buyer. If you don't have any buyers and a bunch of sellers, then this stock will just plummet down. All right, but you can still get movement downward even if you have buyers in the market. So you have more sellers, and then you may also have, here's the thing, not only can it be more sellers or more buyers, it can be 100 sellers and 100 buyers, but the buyers are willing to accept less, the sellers are willing to accept less, and the buyers want to pick it up for less. All right. So if a seller is willing to continually sell for less, right? Because if you own stock, you want to get your highest price possible. So if you're willing to sell it, if this is $20 and you're willing to sell it for 19, 18, 17, it means that you're losing confidence in the stock, right? If I own this stock and I see the stock falling, and then I say, well, I'm willing to sell it for 19, and then I see it fall more, I'm willing to sell it for 18, and then I see it fall more, and I'm willing to sell it for 17, buyers are going to be glad to pick that up, right? And as long as there's more sellers and buyers, because buyers are going to pick it up, eventually sellers are going to run out, and buyers are going to keep swooping all these shares up, because for every seller, there's a buyer, right? So for every seller, there's somebody who thinks it's cheap, and it's going to keep falling. These buyers are going to pick it up. Eventually, the sellers, we're going to run out of shares to sell, and then there's going to be all this buying demand left, and then the stock is going to move higher. That's how a stock moves. So when you have these areas like consolidation, you have over supply, over demand, and you're looking for that break. All right, you guys, hopefully this clears it up. Once again, shout out to David. Hopefully this helps a lot. But like I said, I want you guys to see this as a community, and do not be afraid to send me an email, to get in touch with me via direct message. I'm active on email. I'm active on social media. So please feel free to ask questions. I enjoy teaching you guys. I really do. I enjoy helping, and I want to create as many successful traders as I possibly can, because there's a lot of bullshit. There's a lot of bullshit out there on the internet. So I want you guys to have a place where you can come to and know that you're going to be fed real, legit trading knowledge. So that is consolidation. I am Derek Polishek. This is Finance and Chocolate. I will see you guys in the next video.